Welcome to part 4, where we will see best mutual funds in market correction for SIP in 2023. Please remember, this video is made only for education purpose. Mutual fund investments are subject to market risk. Past success does not guarantee any future returns. Please read all scheme related documents carefully before making any investment. So the first one is multi-asset fund. Multi-asset allocation funds are hybrid funds that must invest a minimum of 10% in at least 3 asset classes. These funds typically have a combination of equity, debt, and one more asset class like gold, real estate, etc. So the first one in multi-asset fund is ICICI Prudential Asset Allocator Fund of Fund, which has an AUM of 17,660 crores and it has given a return of 10.24% in 1 year, 14.45% in 3 years, 12.73% in 5 years, and 11.89% in 10 years. The second is SDFC Multi-Asset Fund. It has an AUM of 1,624 crores with a return of 10.41% in 1 year, 15.14% in 3 years, 13.05% in 5 years, and 10.70% in 10 years. Now, what are the advantages of multi-asset allocation funds? See, the first is lesser risk than most hybrid funds as the investments are spread across multiple asset classes. Lower allocation to stock means the returns can fall behind in rising markets. Suitable for investment horizon for at least 3 years. Aggressive hybrid funds is the second category. Aggressive hybrid funds are mutual funds that invest mainly in stocks along with a limited allocation in debt instruments. These funds can have maximum exposure in equity up to 75% with at least 25% allocation to FD-like instruments. The first one in aggressive hybrid funds is Canara Robeco Equity Hybrid Fund with an AUM of 8,476 crores and it has given return of 10.54% in 1 year, 15.21% in 3 years, 13.88% in 5 years, and 13.46% in 10 years. The second is Quant Absolute Fund with AUM of 762 crores, returns of 23.74% in 1 year, 33.45% in 3 years, 26.33% in 5 years, and 19.54% in 10 years. The third is Kotak Equity Hybrid Fund with an AUM of 3,067 crores, returns of 11.99% in 1 year, 19.43% in 3 years, and 15.95% in 5 years. The fourth is ICICI Prudential Equity and Debt Fund with an AUM of 21,109 crores, returns of 17.28% in 1 year, 26.56% in 3 years, 19.62% in 5 years, and 16.16% in 10 years. And the last is SDFC Hybrid Equity Fund with an AUM of 19,131 crores, returns of 17.32% in 1 year, 20.24% in 3 years, 14.98% in 5 years, and 12.38% in 10 years. So who should invest in aggressive funds? First time equity investors, investors with a for 3 to 5 years investment horizon, and investors who are near their retirement age. The third is conservative hybrid funds. Conservative hybrid funds are hybrid mutual funds that invest 75% to 90% of their total assets in debt instruments and the rest 10 to 25% in equity. It is prefixed with conservative because a majority of its assets are investing in debt securities, which are considered to be highly safe avenues. The first in this category is Kotak Debt Hybrid Fund with an AUM of 1,601 crores, 7.65% returns in 1 year, 10.32% in 3 years, 10.11% in 5 years, and 9.51% in 10 years. Second is SBI Conservative Hybrid Fund with an AUM of 6,807 crores, returns of 7.66% in 1 year, 10.84% in 3 years, 9.91% in 5 years, and 9.07% in 10 years. The third is ICICI Regular Savings Fund with an AUM of 3,303 crores, returns of 7.53% in 1 year, 8.88% in 3 years, 8.86% in 5 years, and 9.47% in 10 years. And the last is Canara Robeco Conservative Hybrid Fund with an AUM of 1,143 crores and returns of 6.10% for 1 year, 7.90% in 3 years, 8.65% in 5 years, and 8.40% in 10 years. What are the advantages of investing in conservative hybrid funds? They give higher returns than FDs, relatively less risky than other hybrid funds, and they have well diversified portfolio. So if you want to invest in banking, basically, for example, if you are investing your fund in banks for FDs for 3 years, 5 years, 10 years, whatever it is, then better to invest in conservative hybrid fund because they give very good returns, as we have seen, better than FDs, right? And they have a well diversified portfolio which helps to protect the whatever investment you are putting into it, and they are relatively less risky compared with the other hybrid funds. The fourth is equity saving funds. They are hybrid mutual funds which invest almost an equal amount in stocks, FD-like instruments, and risk-free hedging instruments. These funds tend to provide better returns than bank fixed deposits of similar duration. The first in equity savings fund category is Mirai Asset Equity Saving Fund with an AUM of 588 crores, returns of 7.77% in 1 year and 11.47% in 3 years. The second is Kotak Equity Saving Fund with an AUM of 2026 crore, returns of 8.85% in 1 year, 10.50% in 3 years and 9.35% in 5 years. The third is SBI Equity Saving Funds with an AUM of 2,430 crores, returns of 4.91% in 1 year, 9.66% in 3 years, and 8.87% in 5 years. The fourth one is Axis Equity Saver Fund with an AUM of 1,147 crores, 5.79% returns in 1 year, 8.98% return in 3 years, and 8.45% return in 5 years. And the last is SDFC Equity Saving Fund with an AUM of 2,640 crores, 9.77% returns in first year, 12.39% in 3 years, 10.08% in 5 years, and 9.46% in 10 years. The advantages of equity saving funds are users mispricing of stocks in different markets to generate risk-less returns by buying and selling at the same time. Up to 30% exposure to stock means you might see occasional fluctuation in investment value, ideal for an investment horizon of 2 to 3 years. Equity taxation means returns are tax efficient when compared to fixed deposits. Thanks for watching part 4. Subscribe to Coach Fin for stock market updates, mutual fund selection and reviews. Please watch part 1, 2, 3 for which the link is given in the description. See you in the next video. Till then, take care.